Thank you very much, Mr. Yer. Chairman, CIS Kenya, CEO, Governing Council, invited guests, ladies and gentlemen, good morning. Good morning. Give me pleasure to stand here again and remembering that the first time I was heard talking about this mechanism, I don't know, at that time it was not called a mechanism, was in the year 2000. At that time, many people in Kenya had not heard about credit information sharing and what it entails within the financial sector. And I was still an employee of Kenya Commercial Bank, and when I left to start to focus on the development of this mechanism, quite a number of my friends doubted my mission. But it's a good thing that today, with the help of many stakeholders and people who have believed in the mechanism and have contributed immensely, we are now here gathered, and now not talking about the initial challenges and what needs to be done, but how we can now deepen the mechanism to ensure that it delivers on the benefits that we all expect to get from it, both as lenders and borrowers. Now, based on how the theme of the conference has been structured, I would like to mention one opening remark, and it's about a transformation. We know that from Darwin's theory, I don't know whether humans are still evolving, but I think they're still evolving. And the evolution, we need to understand where that evolution is taking place. The evolution is taking place in the mind. Today, I recall many years when I was at the university, I studied mathematics, and I enjoyed that mathematics a lot. But today, when I look at the current crop of students coming out of those classrooms, although the topics are the same, but the approach is so different that they are wired in information not as much as we were wired at that particular time. And therefore, the thought processes that these guys go through is a lot more different. It looks smarter, it's faster, and they can comprehend a lot of things, particularly as far as information processing is concerned. And they have been assisted by the various tools that have been developed. So there's a difference, sort of like I've existed in two phases. The one that was not too digital and the one that has become too digital. So my opening remark is to say this transformation in terms of the financial sector and the financial services that we give to people. At the time we joined the bank a long time ago, we were used to dealing with a natural person. So the natural person, if you can be, people come in through the door of the branch, and you're able to see them, and you can confirm that I was dealing with so and so. But today, business cannot be done like that. So we're moving away from the natural person to the digital person. And the digital person moves in a different space. The only challenge we have in that space, how do you ascertain the legality of this digital person? Because you've got to know credit is a contract, and every contract has its terms, and at some point, if somebody breaches the terms of the contract, you will require enforcement of that contract. And when you come to enforcement, then you have to move to the side of the law. And so we need to understand that as we move from dealing with natural people, we're moving into the digital space. We are left with one fundamental question of identity. How do we ensure that we are dealing with that person that we believe is the right person. And therefore, in this conference, I think we are all agreed from the presentations that have been done before, what the governor talked about, that everything is moving towards the digital space. And we as Credit Reference Bureau, the focus being the collection and processing of information. The questions we're asking ourselves is, how do we develop the capabilities that are required to ensure that at the time you require to make that credit decision, you have the right information, the right quality of information, and information that can enable a sound decision to be made. The thing that I keep telling lenders is that, yes, we're used to making decisions, but a time has come where decisions will have to be automated, and we may transition towards managing the decisions that have been made in an automated environment. That could give a traditional credit officer a bit of sleepless nights, but I think that is the reality going forward. So, if we look at the CIS mechanism, a little bit of the background of how it started will be able to give us an understanding of what the challenges today are. In Kenya, there has been tremendous effort, and by a lot of interest groups and participants, towards ensuring that we get the structures of the mechanism right in place. First attempt was in 2004. The regulation that came out in 2004 provided that banks may share information with each other. That was too loose. It never moved at all. There was another attempt that was made in 2007 that gave the regulations of 2008, and that regulation mandated banks to share negative information with licensed credit reference bureaus. So at least there was a structure that emerged. And when the bureaus were licensed, banks started sharing negative information, that is information on defaulting customers. And the bureau was then projected in the public as a depository of negative data. And it assumed a social aspect to it, that if you were in the bureau at that time, you were a bad person. And over time, and even up to today, many people would call you and say, I know my name is in the bureau, I need my name taken out of the bureau. Of course, that was a perception that was created by the manner in which the mechanism first came into being. But that changed when the regulations 2013 mandated banks to share both positive and negative information and allowed third-party credit providers to join the mechanism. So today you are in the bureau because you're exposed to credit, you have a credit contract with someone, whatever it is, who is authorized to participate in the mechanism. And that perception issue is a challenge to us, both as bureaus and as lenders. And it's something that we need to continuously keep imparting to the market, that the bureau is not a blacklist. The bureau is an organization that collects credit histories, puts this credit history together, and generates value out of the credit quality data that is there in terms of risk measurement. There are other challenges that we've seen about data, and data will be talked about here. But today, yes, we're getting end of month data from credit providers, but because we have moved into the digital space, that is becoming a challenge. We need instant data because the credit scores, and I will show you some slides about customer mobility. Customers are moving from one lender to the other in a matter of hours. And if that information is not available in the credit bureau to reflect the correct status of the customer credit risk in terms of their scores, then it becomes a challenge to the lender that you are actually making a decision without the full profile of your customer. As far as Metropol is concerned, who do we currently serve today? Of course, we serve all the banks and microfinance banks. We have over 1,700 SACCOs sharing data with us. We have over 200 credit-only microfinance institutions and over 300 trade organizations that have subscribed to share information with us. The amount of data that we process today is a lot of data. And every time we are constantly expanding our capacity to ensure that as that data comes in, we are able to process and make it available to you as lenders who want to make decisions about the borrowing customers. And at the rate at which we are onboarding new credit providers on board, I think that within the end of the year, we could be having close to about 3,000 credit information providers on our system. And a month ago, I think the governor did call the credit reference bureaus. The three institutions went for that meeting. And the core of that conversation was, are credit reference bureaus ready to serve the market in terms of providing the credit scores that would drive risk-based pricing? And I think that credit reference bureaus in that meeting did demonstrate that indeed they have the capability to provide scores that are required at an instant in whatever manner that they are required. And that confidence, I think, moved the governor to issue the bank charter that has now been issued because the credit reference bureaus have that capability to provide scores. Now, I know that each one of us will be talking about what they have done in that particular space of credit scores. I need to talk about what we as Metropol have done in the credit score. Now, the credit score that we have is called the Metro score. And the Metro score it has a scale of 200 to 900. A while ago, we used to say it has a cutoff point, that if you have a score of below 400, then you have default items. Today, because of the scoring mechanism and the dynamism that is required in that environment, the scores keep changing and they would reflect different status at different levels. So it is not about you being categorized as being belonging to this category where you are a defaulter and belonging to this category where you are a good payer. The scores will reflect your position as far as the parameters that determine that particular score are concerned, and that can change at any time of the day depending on the data that comes in. So the Metro score, we have 11.3 million customers on our database who have been assigned the Metro score. And you can see the distribution of the Metro score in terms of the credit standing. And if you look at that particular graph, you can see that the range between 200 and 270 has a slight percentage of about 14%. But of course, scores towards the 200 reflect customers who have default items, irregular payment habits. But as you move from the 200 to the 900 category, then you find customers who have maintained very good scores. And if you run an average, then you find that the average credit score for the Kenyan borrower stands at about 615. Now, 615, what that means, because 615 is a score that reflects good payment behavior. It may be that you have a slight challenge in your credit mix the type of loans you've been taking between installment, revolving, and open account. It may be that you have high credit activity, such as in the credit environment, but it is not a bad score. And that reflects with what we see in terms of the NPL percentages and the performing loans. And therefore, these scales right now, because of the amount of data that we have, includes data that has come from the banking system, data that has come from the SACCOs, data that has come from microfinance institutions, and data that has come from trade credit supplier, because these customers are moving across the board, and we are able to incorporate that data to be able to calculate these scores. Now, if in terms of probabilities of default, you can see that customers who have scores of 200 up to 400 have high probabilities of default. But as you come towards scores of 600, towards the 900 scores, the probabilities of default drop at a very high rate, so that you have the range above 850 customers having a probability of default of 0.2%, which is extremely low. Now, this information is important information, and it is dynamic. If you're hooked onto our systems, scores will keep changing, and we have mechanisms that can alert you that the score that you used yesterday has actually changed because of new information that has hit the customer's profile. Now, we've talked about the rate cap. So we did some analysis and said, what was the distribution of scores before the rate cap, and what is the distribution of scores after the rate cap? Did the rate cap influence the type of decisions that banks are making by using this particular? And we found interesting stuff, that there is no significant difference between the decisions that were made before the rate cap and the ones that were made after the rate cap. How much of this information is actually getting into the credit decisioning process? The sad news about this whole thing is that when the mechanism started, and because we were only sharing negative information, the credit report was being used to say yes or no. Are you listed? Yes, no credit to you. Are you not listed? If you're not listed, come in, we can be able to talk. Then as a bank, we'll use our traditional appraisal techniques to see how much to give to you. But when we moved to full file, where there was now positive and negative information, and even progressed further to introduce credit scores, there has been a lag on the part of the lender to move with that development. So a majority of the lending decisions are still on a yes and no. In fact, we were talking to one of the appraisers in one of the institutions, and he said, we have recognized the Metro score, and we're using the Metro score. But the way we use it is that if the guy has a score of less than 400, the answer is no. If the guy has a score of more than 400, then we can look at it. So there's no significant difference in the way the credit report without a score was being used with a score that is now supposed to communicate more information to the lender. And that's why this particular graph is looking the way it is. And therefore, we are of the view that the borrower's risk characteristics have not been fully integrated into the credit decisioning from a credit bureau perspective. I know lenders say internally we have credit scores, developed our own scoring, and therefore we understand. That is okay. But internally developed credit scores have two major setbacks. One, they are policy driven, because the information that you have is based on the kind of credit policies that you have put in place. So they will always have a policy bias. The second is that you then do not have access to the customers borrowing from other entities. And if then your credit scores do not incorporate information from the credit bureau, then of course that shortcoming will be reflected in what you are doing. If I have to move, basically that is what I'm trying to infer from that particular graph, and we will be able to see how that progresses. If we look at the Metro score for businesses, again it reflects the same distribution where you have customers in the 0 to 40, and of course towards the 100, the 90 to 100, also displaying the same characteristics. Now, there have also been significant gains as far as product diversity and growth is concerned from lenders. And what have we seen? What we've seen is that the mobile loan product has grown tremendously. I mean, the big banks, every bank has a mobile loan product. Some have even got two. Most of us are familiar with the one that first came into the market, the M-Shwari, and many others. The fintechs have the mobile loan, are giving mobile loans over the phone. And this particular area has grown tremendously. In fact, the number of players who come into the market now find it easier to enter this space than go the traditional way of extending credit. And therefore, acceptance rates for many customers has actually increased, as opposed to what used to be there before the credit information sharing started. If you look at, the acceptance rates, you look at this graph that is generally upward trending, you will see that generally based on the number of applications, there are more customers being accepted than customers who are rejected based on their credit profile. Now, new customers coming into the borrowing space do not have credit histories. So it's usually a matter of chance. And that is one of the areas where the fintechs have been tremendously innovative. I have also observed, or we have observed as the analytics team within Metropol, what we observe is that customer characteristics have tremendously changed. Customers are adapting to the new digital space because now they know that you will never have the opportunity to see or to meet them. They know that they will make an application and you will only be using the data that is provided in that space to make that decision. So we have seen some interesting things that I will be able to share with you. And what we see is that, of course, here is the microloans and business loan growth. Also, that has grown. Cost of default has not increased that much. That means that are there many write-offs? No. This is where the focus of my presentation is in terms of what we have seen arising out of customers in the digital space. Now, there's a tremendous amount of multi-borrowing. The average number of accounts that a customer today has is 5 within the banking sector and outside of the banking sector. And most of those accounts are on the mobile platform. Now, you can see when we do the analysis, there are customers within that particular space who are being paid, and there are others who are not being paid. So we've done an analysis to be able to see that out of the entire universe, how many are paying everybody? How many are paying just one? How many are paying two? How many are paying three? How many are not paying anybody at all? Now, the interesting thing about this is that because I know that I will need a lender tomorrow, the possibility of moving around debt becomes a reality. I can borrow from one lender and pay another one as long as I want to keep a certain lender or certain lenders happy within that particular environment. And what we tried to do, we took a sample of a few customers and said, let's track these customers and see what is going over a period of 8 months. And what we saw is that over that period, the customer chooses to pay certain lenders and not necessarily others. Now, what some of these guys, remember when the mechanism started, I think there was focus on a serial defaulter. The serial defaulter was the most dangerous borrower in this market because they were moving around and taking credit from banks and not paying back at all. And of course, when the institutions collapse, they are taken to the Deposit Protection Fund, but the guys are out here continuing to take credit. When banks started sharing information, they moved to the SACCOs, which were not sharing information. So we see that type of behavior still going on. That some people will try to find out, is this institution in the loop of sharing credit data? If they find that that institution is not, what happens is that credit can be taken from that institution and this guy will not be known. But the overall debt that the customer is carrying, both in where it is shared and where it is not shared, continuously keeps increasing. That has been one of the motivations for us to say, can we try and bring as many credit providers as possible on board so that we keep expanding the space where this particular individual who wants to keep certain transactions opaque from the sharing environment to be completely taken out of the system. Now, if you look at in terms of the average debt, we have also discovered that the average mobile loan debt at default usually is about 3,400. Now, I know that some lenders will start on 500 and 1,000, and then you keep building it up. But what we have seen, as it builds up, when it gets to that level, and then the customers default. So that's an average. Again, that is a characteristic. In terms of the other loans, the average tends to differ. Now, there is a tendency for some of the personal borrowing on the mobile phone actually going to finance business. And a lot of that is being used for business purposes. So again, that average at the time of default is a significant item that we're looking at. And it's always in the category where you start the customer on a low amount and you build confidence up to a certain point. Going further, and in terms of how we are approaching the business, we are looking at empowering the ecosystem, empowering the customer. Yes, customers have credit scores on the bureau. Do they know about it? Some do. But even if they do, what can they do with those scores? So we have started a program as a bureau, which we're calling a credit community program. Now, if I define a credit community is simply a geographical zoning of people who live in the same region. Like if we were to zone Nairobi, we'll say people who live on this side of town. That means Ruaraka and what is this place? Always up to Githurai. That would be a credit community. What we've done as a bureau is that because we are able to analyze data in terms of how it comes to the bureau by the location of the credit providers, we can study a credit community and try to understand how that community is accessing credit and how they are paying that particular credit. And we have found very interesting things in this credit community program. So I'll give you an example of what we did in Nakuru. Nakuru has about 5 counties, and what we did is to try and understand what is the credit experience within that particular region. And we saw that in terms of the group borrowings, from an age point of view, you have the elderly, you have the middle age, and you have the youth. That is the distribution of borrowers in that particular locality, with about 5 counties. And we looked at the same is that what are the sectors that are actually borrowing within that particular locality. So we found many of them are financial services, energy, agriculture, transport, real estate, all the way distributed like that. That's what that community is borrowing for. And we looked further and said, in terms of the total lending between banks, microfinance institution, and SACCOs, what is the distribution of how much share is each lender taking? And that is what we find, that banks still hold the majority of the lending within these particular communities. But of course, you have microfinance institutions coming up, some of them locally set within those particular areas. And we looked at if one is not borrowing within that community, because you see, you would expect that if I live in Nakuru or within the environs, I should find credit within that environment. I should not come to Nairobi to seek for credit. But we did find that there are some residents of that particular locality who had come to other towns to seek for credit. And we asked, what were they seeking credit for that was not available? So we looked at the types of facilities that they were getting, trade finance facilities, lines of credit, asset finance, and we find that the lenders within that particular localities were not providing all the loan facilities required by that particular credit community. And therefore, so we built a whole, and we looked at the distribution, for example, between customers, multi-borrowing customers, again within the same community. How many are borrowing from the banks? How many are borrowing from the others? And we were able to get that distribution. And we also looked at the defaults. How many have defaulted with one institution, with 2 institutions, and how many are servicing 1 institution, 2 institutions, and so on. And that is what we found. And in terms of the demographic preference, in terms of NPLs, we found that the majority of the defaults are within the youth. And the youth are taking mostly mobile loan products. And again, that is a characteristic that we saw. And In terms of business performance, again, we are able to analyze between small, micro, small, medium, and large enterprises within that particular region. And again, we're able to see in terms of the uptake of loans, the distribution of these entities. And if you look at, again, business performance and in terms of even the type of borrowing, again, within that particular community, we're able to analyze and see what is trade, what is going into mining, what's going into manufacturing, real estate, and all that. And therefore, what is this concept of the credit community? The credit community is designed to enable people within a given community to understand each other, and we're using that platform to be able to propagate the story of the credit scores. And what we are seeing, having gone around the country, because we've divided the country into several parts, into 10 different regions, having gone throughout the country, creating these communities and explaining to them how credit is intertwined within the locality in which they live, we have seen an increasing level of awareness and use the need to want to share information with the credit reference bureaus, because now people feel that because I do business within this particular area and I can be able to see the profile of the people I am dealing with, it makes sense for us to join the mechanism. And that is an initiative that we're now taking seriously to see we can use that platform to educate borrowers about the potential of credit scores. In many of the workshops that we have conducted, banks with their branch staff have always attended those workshops. And what we have seen is that there's an increasing level of interaction and awareness of how these people can work together. And just to give you some further statistics, after starting the credit community program, we have seen that every month, the number of CIPs, the number of credit providers who want to join the mechanism is increasing every other day. And people are now walking into the offices and saying, I was told when I went to this lender that my score is this, but they never explained. Can you be able to explain to me what this particular score means to me? And we think that this kind of engagement program is a program that we can use to further explain what credit scores mean and how credit scores can be used to create responsible lending within a given credit community. Now, we divide customers into 3 categories. Within those credit communities, we have what we call angel customers, the customers who have credit scores of 700 and above. We have the marginal customer who has anything, credit scores between 500 and 700. And then we have credit scores, customers with credit scores below 500. And this categorization has helped a number of lenders actually also try to segment customers within those credit communities. And more importantly, this guy called a serial defaulter is actually being kicked out of those environments, which means that there's increasing transparency and increasing use of available credit information to manage the credit risk within the environment. Now, I'll go to this particular program, which is a program that was started by the Higher Education Loans Board. It's called Jenga Future. And I was telling the chairman, Mr. Ingera, that this was quite a visionary program. What this program entailed was basically to go to the universities and talk to the students who are applying for the Higher Education Loans Board and introduce to them the concept of credit information sharing. And we went round, and I think that based on what the credit community concept, this dovetails well with this kind of program, because beginning to create awareness at that level where somebody is just beginning to get their first credit and understand how that credit, what it will mean when it is on the Credit Reference Bureau, is a significant step in that direction. And here is how it will work. That if a student gets a loan, a credit bureau profile will then be opened, but it will not be activated. The student will be advised that an entry now exists within the Credit Reference Bureau and you have a profile. Those lenders will contribute data to your profile. However, the education loan you have taken will only be activated after you complete your program and the grace period that the program provides of 1 year. So it automatically kicks in. And that then begins to build the credit profile that you need, which you can then use as a means of engaging other credit providers. And this kind of program, based on what we have seen in the credit community concept, is a good introduction to those who are just entering into the credit market. So I am telling Charles that we need to go back and look at what he has done and rethink through how we can re-engineer this particular program so that awareness of the existence of credit reference bureaus and the impact they can have on a student's borrowing life starts at a very early stage. As I close, how do we see the future ourselves? It's about big data. It's about knowing everything that a customer does, having a 360 view of the customer's transactions. Are we prepared as credit bureaus? I've explained to you the program that we have in place to try and capture everybody so that visibility on the bureau becomes eminent. Analytics is the way to go. And we are investing heavily in analytics to be able to digest, to cut and dice information and give back value to lenders that was not ordinarily available. In the digital space, we've got to keep creating new value. The credit theory as we know it has completely changed, and therefore how we define value in the digital space is going to be different, and that can only be supported by analytics. And of course, we would like to work with the fintechs. They have interesting algorithms. And the thing I want to say about this fintech entry into the financial sector is that it is important that information is shared with other lenders. Because what the danger we are seeing, and this we have just started an analysis, is that there is a considerable build-up of debt. People are building up debt because if the response that you're getting from the bureau is a yes and no, as long as the customer is paying, the credit score will be in the region of 600 and above. But if you're not minding any other value other than the yes and no, you will not be able to detect the fact that the customer's debt values are building up. And every time they reach the cliff, then they fall over. And the rate at which they will start falling over is because they have built up so much debt that now it becomes impossible to manage that debt. So it is important that yes, information is available in the Credit Reference Bureau, but it's got to be used in an analytical sense. And we, in terms of providing the parameters of the credit scores, we have provided the contribution of what each component actually entails. So you will not be able to know that this customer is reaching unmanageable debt levels. And of course, in terms of going back for a lender, it's not about, the future is not about having to charge more interest to the customer. The future, the bank or the lender that is going to have a successful future is a lender that is able to reduce the cost of borrowing. And the cost of borrowing means adopting new technology and being able to make decisions much faster, so that the margin that you create by reducing costs can then be able to contribute significantly to the profit that you have. And with those few remarks, I would like to say thank you very much for listening to me, and have a successful conference.